everyone. Today I'm here to share about our Eastspring Investments Dinasti Fund and the Greater China Strategy. For those that don't know me, I'm Yu Roy, the Eastspring Fund Manager for Greater China. So without further ado, I'll take you through today some of the review of what has happened in the past month, and then we'll also talk a bit about the outlook and what is the strategy moving forward. So just a very quick review of what has happened in the past month of March. What we saw in March was that markets were in traded in volatile fashion, and we saw that the S&P actually took about around 6 days to close 10% below its recent peak on February 19, 2020. In the span of this time as well, in March, several key events globally happened that caused the fastest ever US bear market we saw. First of all was a near collapse in oil prices as Russia and Saudi Arabia couldn't come to an agreement to halt production. We also saw stress in US funding markets that increased investor anxiety. And with all this, we saw that the S&P erased gains that it accumulated for the past 3 years in less than 3 weeks. A total peak to trough decline of close to 34%. Year to date, the only assets that showed a positive return were US Treasuries on the back of central bank, especially the US Fed announcing its QE measures, and also gold as investors sought for safety. Despite this, even US Treasuries and gold was not spared in the month of March as asset correlations broke down, and even those two assets saw investors sell off amid fund redemptions and outflows. All other asset classes year to date experienced negative returns, with the worst being oil prices. So what we saw year to date was a broad sell-off in asset classes, but however, we would like to point out that China A's market actually outperformed the other markets, as China actually saw cases peak faster than the rest, and also saw an improvement in the situation facing COVID-19. Here we have a US jobless claims data. What we saw was that US initial jobless claims actually started to spike in March, but the data actually does not yet indicate the latest jobless claims number. The latest jobless claims number stood at 3 million, and that is 30 standard deviations above the one you're seeing in the chart on the left. So if we were to actually update the chart, it would look a lot worse than what it shows right here. On the flip side of things, what we saw was that the China Economic Recovery Index actually showed signs of continued improvement, recovering to a level close to 80% of what it usually is. Other data that we track, such as coal consumption data at power plants, also indicate a close to 70% take-up from normal levels at around this time. All these are quite encouraging signs coming out from China. With economic situation being pretty bleak today, what we also saw was that global central banks actually undertook a score of actions to help support markets. To begin with, the Fed actually slapped not only the US, but also other central banks globally slashed interest rates, but also embarked on other forms of monetary easing, like, for example, the US embarked on quantitative easing, committed to similar measures of bond buying. While central banks are doing what it can, governments also step in to help with commitments of more fiscal stimulus. And the US is actually committing to more than 10% of its GDP worth of fiscal stimulus to help support the economy. Moving on to Asia, we see a similar pattern where most Asian countries are actually committed to forms of monetary easing as well as fiscal stimulus. China stands out today because of the amount of fiscal stimulus as a percentage of GDP is not yet very big. So that is one point of concern for investors, that are now hoping for China to ramp up fiscal stimulus to help support the global economy. We think that might likely increase in the future, but it would probably not be as big as what we saw in previous crisis episodes, such as that during the Asian financial crisis and also the one we saw during the global financial crisis in 2008. Moving on to stock market valuations, we find that stock markets now are trading at very attractive levels, with both the Hang Seng Index and Hang Seng China Enterprise Index trading at close to 1x price to book, a level we last saw during the global financial crisis. On a 10-year historical chart, we see here that Asia ex Japan is trading at 1.4x price to book, close to the 10-year low. However, markets like the US is still somewhat away from its 10-year price to book low. There is, however, a caveat here because today price to book tends to be a lot higher than previously because most of the global indices are dominated by tech heavyweights, which tend to trade at higher price to book multiples. For Chinese A shares, it is also looking quite attractive, with stocks now trading at one standard deviation below its mean. Today, A shares are trading at about 9.5 times forward earnings, which we find very attractive. Looking past COVID-19, we think the longer structural trends still continue to underpin Asia. Such trends are 5G, e-commerce, online gaming and education, healthcare, shifts in supply chains towards Asia, and urbanization. Lastly, we think certain government policies and consumer behaviors tend to outlast even the virus. So with that in mind, in terms of strategy and sector preference, we prefer sectors such as online e-commerce, education, healthcare, as these sectors are likely to continue to outperform the market even post-COVID-19. We think a recession now looms, but a peak in infections and aggressive monetary and fiscal measures can support markets eventually. And hence, this could be a good time to accumulate good quality names. Our style is more tilted to quality and growth at reasonable prices, as we think these two styles would withstand the tough periods to come. Companies with strong cash flow and balance sheets tend to fare better during crises such as what we are facing right now. A bit on the fund we manage, which is Dinasti. Right now, we are holding about 8% cash, and we will look to deploy this cash when we see opportunities to buy quality stocks arising from broad-based panic sellings. To end the presentation, I would actually like to leave off with two quotes. The first one by Baron Rothschild, saying to investors to buy when there's blood on the streets. And we think today there is definitely signs of that. The second one from John Maynard Keynes, saying that markets can stay irrational longer than you can stay solvent. I think that is just a cautionary tale that markets, although cheap today, can still fall further because there is still some risks out there, such as a second wave of infections and also the global economy extending the fight of COVID-19 into 2021. That we think would certainly be some of the downside risks facing us today. However, given the attractive valuations and global monetary and fiscal support, we would advocate for investors to adopt a dollar cost averaging strategy to mitigate some of these risks.